Hey everybody, welcome back to the channel. We are back on another episode of the Daily Recap, and we have got a lot to talk about in the volatile world that is the stock market. Palantir has another deal, so we'll talk about Palantir. This is 3 deals back to back to back. It's nice to see. We haven't gotten these many deals really since 2024. So we got a new Palantir update we're going to talk about. Obviously, we got some more stuff to talk about with tariffs. There are a variety of things happening today in regards to a delay of tariffs, an increase of tariffs, etc. So we'll be talking more about tariffs. And then we also have some stats that I think are going to be really interesting for people to hear that kind of determines a little bit of a market bottom, potentially, when you listen to the stats. But in those times, the historical metrics of these stats didn't have the ever-looming threat of tariffs and then the taking away of that threat simultaneously within 24 hours. So lots to talk about. Let's get into it. Okay, so first thing we'll get started with is tariffs. We had a bunch of different things that happened today. Number one, during the morning, Howard Lutnick came on CNBC and he basically talked about this idea that companies need to start manufacturing their goods in the United States. What was really interesting about this is he had a pretty fiery exchange with CNBC, and they asked him a pretty simple question, in my opinion, which is a fair question, which was, hey, if we bring goods and services to the United States, which is what the goal of the tariffs is, right, to get companies to produce in the United States, wouldn't that make things like cars more expensive for U.S. consumers? Because obviously cost of goods would go up. Howard Lutnick's response was twofold, and in my opinion, it just wasn't that good of a response. So the first thing he said is that if we take away the import fees, then there's going to be less of a price gouging on these vehicles, or in the context of cars, which is what he was talking about, because you don't have to pay that much to import the cars into the United States. Therefore, the prices went down. That's not necessarily correct in my opinion, because their cost of goods are still going to be high. Paying an American worker versus a Chinese worker are different, right? Night and day. In America, we have things called the minimum wage. In China, we don't. So then the follow-up from the CNBC reporter is like, wait a second. Okay, so you're saying we don't have to pay these import fees, but wouldn't the cost of goods still be higher? Because in the United States, we have like laws and restrictions on how much you can pay versus in other parts of the world. And then he has the second part of his answer, which I just couldn't understand it. And you know, I think Howard Lutnick is a interesting individual. I think he ran a Cantor Fitzgerald, which is an investment firm. So it's not like the guy is an absolute idiot. But the answer he gave was just not that good of an answer. He said, well, the robots will make sure that costs come down via automation. And you could just tell it was the most used car salesman type of vibe, because that doesn't make sense. We are not going to have massive amounts of automation and robotics in the next couple of years that are going to be so significantly decreasing the cost of goods on TVs, t-shirts, iPhones, iPads, laptops, etc. Like, that's going to happen one day, but it's not going to happen in the next 2 years. And it's definitely not going to happen if Trump imposes tariffs and gets all these companies to flip their supply chains overnight, because there's going to be so many costs. So if most companies can't flip their supply chains overnight to have the manufacturing capacity in the United States, that's not going to work for those companies to be able to reduce costs. If the robots come in, they're probably not going to immediately be able to make a difference, because companies are not going to be able to flip their supply chains up overnight. So then the question becomes, what answer is he trying to give? How does any of this logically make sense to impose tariffs, bring back manufacturing? The manufacturing is not actually going to drive down costs. And then on top of that, you've got robots via automation, which aren't ready yet at an industrial capacity to meaningfully reduce costs, as his solution to how the cost of goods come down, which is why it's better to make your products in America versus in China. The most ironic part about all of this is that if he's right, let's take his argument at the highest level, and let's say, yes, robots are going to automate everything and cost of goods are going to come down. Where are the jobs coming from? Because if the robots are doing the jobs, then where's all these new jobs that are great for American workers? So the whole exchange made no sense. And the reason I think it made no sense is because the president and the Trump administration don't actually want to engage in tariffs. Why don't they want to engage in tariffs? Well, because Trump spoke with the president of Mexico and he wrote, I have agreed that Mexico will not be required to pay tariffs on anything that falls under the USMCA agreement. This agreement is until April 2nd. I think the markets are basically realizing they cannot trust what Trump says. And the reason they can't trust what Trump says is because at this point, Trump has been the boy who cried at tariffs at least 5 times since January 28th, if not more. And the fact that he's been saying this over and over again and then not following through, and at the last minute having this magical agreement with the president of Canada or the president of Mexico and being able to resolve it in some type of way. We knew that he was on the phone yesterday with Justin Trudeau and also was able to get a somewhat friendly at least end to their call, meaning there's likely going to be a negotiation coming up soon. No one believes in tariffs at this point. The administration is not proving that you should believe in it. And as a result, I think the markets are going to continue to be volatile and uncertain until there is a resolution to this. Now, do I think it's going to go on for the next 4 years? No. But we have aluminum and steel tariffs that are definitely happening in March 12th. So 6 days from now. Those are not going to be negotiated away. The China tariffs, there's been no progress on those being negotiated away. Mexico and Canada are our allies, which is why I think we're going to get more likely to have agreements. But we are basically in a trade war. China's retaliating. And unless there is a resolution to that and a resolution to the overall uncertainty that Trump's bringing to the market, yeah, we're going to keep being in a pretty uncertain market. Last thing I'll say on this is that maybe this is what Trump wants. Again, to get bond yields to come down, people need to buy bonds. In order for people to buy bonds, they need to not want to buy NVIDIA, even if it's trading at a 28 times PE. And to get them to not buy NVIDIA, you create some uncertainties and volatilities in the market. Now you buy bonds, bond yields come down, mortgage rates come down, the Fed can refinance, or the government can refinance the $7 trillion of debt that they have to refinance at a lower rate than about 4.2%, which is what we have right now. That might be the master plan here, and that master plan might create more uncertainties. By the way, Trump did say, he was asked by reporters today in the Oval Office as he was signing executive orders, what do you think about the stock market? And he said, and I quote, "I don't look at the stock market," or the actual quote is, "I am not even looking at the stock market." And then when asked why does he think the stock market is selling off, he says, "There will always be some short-term interruptions, and the globalists are behind the stock market sell-off." So that's what Trump had to say about the stock market selling off over the past couple of weeks. All right, next up we have is Palantir. We have back-to-back deals on Palantir, which is very exciting because we haven't gotten these types of deals since 2024. EYSA and Palantir partner to enhance mobility application development. EYSA is a company in Spain. They are a global group that provides innovative solutions to improve mobility and promote sustainability for transportation infrastructure. This is a 3-year agreement, which will allow EYSA to integrate Palantir software with the goal of accelerating the development of mobility applications and use cases across its various operational lines, as well as capturing new business opportunities. They actually conducted a multi-week boot camp in Spain with Palantir to evaluate the feasibility of various use cases related to parking management, sustainable mobility, and urban services. I think this is really bullish because, number one, it's another client they got from a boot camp. Number two, it's a 3-year deal. And number three, more international commercial. We had Societe Generale, which was in France, one of the largest European banks, 1.6 trillion in assets. That was amazing. TWG yesterday, that is a global international holding company. And now today, a company in Spain. I think the reason they did these 3 press releases back to back to back is because they're trying to show the market we're not just a company that can grow in the US in commercial, we can also grow internationally. And I think that's bullish. The more international customers we have, the better for Palantir. It looks like we continue to grow, and we continue to grow because of those boot camps, which again, to me, is the best sales strategy that Palantir has. Okay, next update that actually broke while I was recording this video. We officially have a strategic Bitcoin reserve. The President of the United States, Donald Trump, just signed a executive order to establish a strategic Bitcoin reserve. The reserve will be capitalized with Bitcoin owned by the federal government that was forfeited as a part of criminal or civil asset forfeiture proceedings. This means it will not cost taxpayers a dime. It is estimated that the U.S. government owns about 200,000 Bitcoin. However, there's never been a complete audit. The EO directly allows a full accounting of the federal government's digital asset holding. Bitcoin right now is down 7.3% at 86,000. And the reason it's down right now is pretty simple. This is a nothing burger. This is an absolute nothing burger. This is not what people voted for if you had crypto as your main agenda voting for Donald Trump. Is this bullish long-term? Sure. Just like a strategic gold reserve or a strategic petroleum reserve is bullish long-term. But people voted for a plan to be able to buy Bitcoin, right? 100,000 Bitcoin per year, 100,000 Bitcoin over 4 years, 1 million Bitcoin. Like, who's actually bidding? Because Michael Saylor just spent $2 billion at 97,000. You need someone to constantly be bidding on Bitcoin. If you take a look at all the ETFs, they have been losing hundreds of millions of dollars a day. On February 25th, they lost 1.1 billion in outflows. The ETFs are not pumping Bitcoin. Saylor just spent all of his money at 97,000. I mean, who's left? There's not that many people that have deep pockets to be buying at these levels, especially with the volatility we're having in the stock market. Who wants to be getting that risk on an asset class? You probably need something like a USG. This establishes no order, no framework, no methodology, no plan on how to buy, when to buy, what mechanism they're going to use to be able to fund the ability to buy more Bitcoin. It's just a notice saying that we're not going to sell any of the Bitcoin, but no one thought they were going to sell any of the Bitcoin. So yeah, this broke just now. I think it's a nothing burger. Let me know your guys' thoughts in the comments, but this Bitcoin is selling off rightly for this because this is not an actual strategic reserve, which is what people voted for. This is a letter with Trump's signature saying we're not going to sell the Bitcoin. This is not what people wanted. All right, our fourth update for the day, jobs data. U.S. employers announced this morning that 172,000 jobs were cut in the month of February 2025. This is up from 49,000 jobs that were cut in January. So a pretty aggressive increase from 49,000 to 172,000. And this is the highest number of monthly cuts since July 2020. Look, this is not the best. This is continuing to show weakening in the labor market, and the weakening in the labor market we've seen from some of the initial jobless claims we got last week. We're going to get non-farm payrolls tomorrow in the morning, so we'll see how that plays out. Jerome Powell also talks tomorrow in the morning, but it's just further evidence of more data that the labor market is not as strong as some people thought it was. And we knew this. We knew the labor market was starting to weaken. A lot of people have been calling BS on the idea that there's all these jobs available. Most likely that's not the case. A lot of people have also said in 2024, hey, maybe the numbers weren't that accurate, and maybe we're starting to see the accurate numbers that show a lot more of a weakening jobs picture than last year showed. But what matters here to me, the most important kind of takeaway from the jobs data we got this morning, is what is Jerome Powell going to do? Now the Fed probabilities on a cut in May are at 50%. It was at 20% a couple weeks ago. Why did it go up so much? Well, a lot of the economic data we've been talking about on the channel has been relatively negative. Now, I think there's a lot of good data as well. So it balances out to an extent. It's not just net negative, but there are some things you can't ignore. And when you're losing 172,000 jobs in the month of February, a lot of that, by the way, coming from government workers who are losing their jobs because of Doge. I think it was about 65,000 people from the government lost their job out of this 172,000. That's only going to continue, and that's only going to increase the unemployment rate. Now, what matters about this, again, is Jay Powell going to cut? In 2021, they waited too late. Inflation was transitory. It became obvious when they had to raise rates, but the problem is when it's obvious, then you're late. Now it's becoming pretty obvious based on the weakening job data that they probably should cut. But if Jay Powell's going to wait and the Fed's going to wait until inflation literally gets to 2% or until something breaks and you actually feel the pain, because right now it's painful, but I don't think the whole world is feeling it yet. If we actually feel it and then they cut, that's going to be a reactionary cut, not a cut that tries to be early before the pain. And as a result, that could be really bad for the equity markets, because if growth slows down, it doesn't matter if rate cuts happen. Growth is going to slow down. For example, if you're a pizzeria, it doesn't matter if rates come down after we start to see economic weakness, and you can finance the cost of building a new oven at like 1 or 2% versus 5%. If no one's coming in to buy any pizza because everyone's losing their jobs and they don't have money, the pizzeria is not going to make any money either. The pizzeria is not going to be able to pay taxes to the government because they don't have enough money to be able to pay those taxes. Like, it's just going to be a mess. So I think it's going to be really important to see when the Fed decides they want to cut, what Trump is going to do to create volatility in the markets in order to get the Fed to cut, and then how the Fed is interpreting this data. We'll hear from Jay Powell tomorrow in terms of what he thinks about the jobless claims and the unemployment data and the weakening of the labor market. That's pretty obvious. Obviously, we get those non-farm payrolls as well in the morning, so we're going to see how that impacts what Jay Powell says. Goldman Sachs says 150,000. If that comes in well below, I mean, you're going to get the markets pricing in more rate cuts. Now they're pricing in 3 rate cuts for the year. A couple weeks ago, it was 1 rate cut. The weakening of the market has allowed the market to want to price in more cuts. The question again is going to be, when do we get those cuts? Do we get those cuts? And does this job data get even worse to force Jay Powell to give us a cut? Next update we have is on Tesla. Bard lowered their Tesla price target to $370 from $440. They said near-term headwinds from Model Y downtime and demand uncertainty adds Tesla as their bearish, fresh pick. This is really funny to me because yesterday we talked about Goldman Sachs reducing their price target. And one of the things I said was that when the price comes down, all these analysts, they get scared, even though they raised it into the 400s during the run-up. Now, as the stock tanks, they have to lower it, which means they never probably really believed in raising it in the beginning. But 440 to 370, here's what they said. We are adding Tesla as a bearish fresh pick given near-term headwinds. Inter-quarter sales data from Tesla's key regions suggests risk the consensus Q1 delivery estimate of 437,000. Tesla, again, also allows 0% APR on the Model 3. A lot of people are thinking that that's because their sales are down. Production downtime associated with the Model Y refresh complicates the supply side, while at the same time, Musk's involvement with the Trump administration adds uncertainty to demand. This is one of the first sell-side reports I'm reading that is saying, hey, that whole Trump relationship we thought was positive back in November, yeah, it's not that positive. anymore. We estimate that 300,000 Model Ys are delivered in a typical quarter, and the downtime adds a risk to the Q1 total. On the Q4 call, Musk stated that now in Q1, we've got this massive factory retooling on the new Model Y, for example, that obviously has a short-term impact on our output. That means that we estimate that Tesla previously updated its manufacturing lines for the Model 3 refreshed in Q1 2024, and we lower our estimates to reflect the downtime. So essentially, they're making some analysis here around the Model Y, the new revamp of the Model Y, of the Juniper version, what that means for the old factory output of the previous Model Y. And then what that also means in the context of if their Q1 sales are not strong because of all this output and delays that they have to do with the Model Y refresh, and you've got a brand that definitively is getting hit. I think FSD and robotics will outweigh the brand problems that is associated with Tesla right now, because there are brand problems from a political perspective. And so long-term, I'm bullish on Tesla. I think long-term, it would be foolish to not think FSD and robotics ultimately makes Tesla a very valuable company. The problem is, it is an issue what's happening with the brand. And I don't think there's a solution to the issue. And I think if you're a Tesla investor, you either sell out of it if you hate what's happening in the short term, or you just hold your nose and deal with it. But the amount of anecdotal data I've seen, and if you just go on X and, kind of look at some sources around how the Germans are thinking of Tesla, how people in France are thinking of Tesla, definitely Europe as an entire continent, how they're thinking of Elon Musk as an individual. Not only are their sales down, but people are engaging in horrific acts of vandalism. Now, that is not a good thing, and I don't condone that by any sense of the imagination. I think it's horrific that people are doing that, but they are doing that. And the fact that they're doing that should be condemned. But we also have to look at the fact as an investor, objectively, what does that mean for the brand? And what that means for the brand right now is that if you're a Democrat and you're associating Trump with evil and Elon with Trump, there is a world where you don't want to buy Teslas just based on that very fact. And if you're in Germany and you think Tesla is a horrible brand because Elon is supporting AFD, which is this crazy far-right party, this is what people consider AFD to be. That's not my opinion on it. But if you think that is the case and you interpret AFD as like a party that's very, very bad, that's going to do very, very bad things and take Germany back to older times when things were not the best in Germany, and Elon is now supporting that, I mean, you're not going to buy a Tesla. It's just that simple. And so whether those claims are accurate or not, this is how people are feeling. This is how Elon's making them feel. At the end of the day, brands are just a reflection of the nostalgic emotions that people have with those brands. And I do think the Tesla brand right now is being tainted. That's not going to stop me from being bullish Tesla long-term, but I don't think that can be denied in the short term. People are not happy with what's going on with Tesla. And as a result, you got analysts that are now lowering their price targets based on this idea that it's because of a brand risk. All right, last update for the day is a couple of stats that I wanted to show everybody in terms of kind of how this market is playing out and if these stats technically could be a little bullish. First of all, yesterday, March 5th, was the third highest day ever in put option volume on the S&P 500. So that means that yesterday, a lot of people felt pretty bearish about what was going on with the stock market. And as a result of feeling that bearish, they decided to buy puts at the third largest rate in history when it comes to being bearish, or at least going technically short on where you think the direction of the market is going. Now, the interesting thing about this stat is that the previous two times this happened marked a bottom in the stock market. So you've got a little bit of historical data on your side on the previous two times when you had this level of option volumes when it comes to puts on the S&P 500 as a bottom. And that kind of makes sense, right? Everyone's scared. Everyone's in fear. The time to buy puts was when the market was at all-time highs, not when it's starting to get to all-time lows, but that's when everyone gets afraid. So it gets into a crowded trade. Crowded trades tend to go the opposite direction of where you think they're going to go. And then boom, you end up bottoming in the stock market. So that to me was pretty bullish. Now, granted, the other two times didn't have this ever-looming threat of tariffs that was taken away every 24 hours within Trump's statements of what's going on in the market. But that's still something that I think we need to think about when it comes to the level of momentum that we have on puts. Second stat that I thought was really important is that the Japanese yen climbed to its strongest level against the US dollar since early October. Now, if you guys remember, August 5th, we had a yen carry trade. What happened? Yen started to get strength because Japan started raising rates. The US dollar started going down. That created a short covering that needed to happen. People sold tech stocks in order to cover their short on the yen because people were short the yen, and that's how they were funding their purchases of tech stocks. That trade unwinded within a day and equities bottomed. And then within the next couple months, most people got rid of that trade. So this is not really a Japanese carry yen trade happening right now. I don't think people are selling off NVIDIA to cover their short on the yen because there's just not that many people short the yen. But the yen increasing, and Japan raised rates last month, maybe they're going to raise them again, and the dollar decreasing is a good thing. Because if you get Dixie DXY coming down, which by the way was at its lowest level all year, 104.17, ended on the day at one point it was at 103.5. That's a good thing because then partners, allies want to do more trade with us because they don't have to spend that much money to engage in the trade by paying in US dollars that are incredibly more expensive against their own currency. So a US dollar coming down is actually a pretty good thing for the overall economy, in my opinion. But the Japanese yen is now getting to levels that it was at basically during that yen carry trade time, which I don't think is necessarily bearish. I think it's actually good because it's making the dollar come down, but it is a stat that we did trigger today. Final stat I want to show everybody is that the S&P 500 came below its 200-day moving average for the first time since November 2023. We have hit the 200-day moving average, which was about 57.42 on the S&P 500 for the first time in about a year and a half. November 2023 should be very familiar to people because that was when we bottomed. Again, technically we bottomed in October 2023, but basically around that time we bottomed. And then 2024 was an amazing bull year for a lot of people. Two bullish stats on a potential bottom signal with put volumes and with the S&P 500 losing its 200-day moving average. Hopefully we can defend that over the coming weeks. And then the dollar weakening based on the yen increasing as well, I think is bullish for the broader economy. Obviously, we've got a bunch of bearish things we talked about in regards to job losses, but those stats, when you put them together, could signal some momentum. It's just we're going to have to see what happens with the threat of tariffs in regards to that momentum actually playing out. All right, that's it for me. Thank you everybody for listening and watching. This is the daily recap, episode number 4. Again, I am really enjoying creating this content every single day, and I hope people are getting value out of it. And the comments that you guys are showing on the videos, to me, lets me know that this is content that people enjoy and they want to keep getting. And I'm going to try to make it better and better and better. I'm going to get on Spotify and Apple Podcasts next week. A lot of people ask for that. So we're going to get the audio version of this stuff out starting next week. And we'll keep going from there. As always, I mess up a lot when I record this. So enjoy the bloopers. A global group that provides innovative solutions to improve mobility and promote sustainability for transportation infrastructure. Reading from the press release, this is a 3-year agreement which will allow EYSA to integrate Palantir software with the goal of accelerating the development and This is a 3-year agreement which will allow EYSA to integrate into what's going on, bro?